Crypto Arbitrage, a comprehensive guide to profiting from market inefficiencies. The cryptocurrency market is known for its volatility, rapid price movements, and decentralized nature. While these characteristics can make trading risky, they also create unique opportunities for profit. One such opportunity is crypto arbitrage, a strategy that leverages price differences across exchanges to generate profits with relatively low risk. In this article, we'll dive deep into the world of crypto arbitrage, explore its various strategies, and identify the best approach to maximize profits. By the end, you'll have a thorough understanding of how arbitrage works and how to implement it effectively. What is crypto arbitrage? Crypto arbitrage is a trading strategy that involves buying a cryptocurrency on one exchange at a lower price and simultaneously selling it on another exchange at a higher price. The difference between the two prices, known as the spread, represents the profit earned by the arbitrageur. This strategy exploits market inefficiencies, which are common in the cryptocurrency space due to its fragmented and decentralized nature. Why does crypto arbitrage exist? Arbitrage opportunities arise due to several factors. Market fragmentation. Cryptocurrencies are traded on hundreds of exchanges worldwide, each with its own supply and demand dynamics. Liquidity differences. Some exchanges have higher trading volumes than others, leading to price discrepancies. Geographic variations. Regulatory environments, local demand, and currency exchange rates can cause price differences between regions. Delayed price updates. Prices on smaller exchanges may not update as quickly as those on larger platforms, creating temporary inefficiencies. Types of crypto arbitrage strategies. There are several types of crypto arbitrage strategies, each with its own level of complexity, risk, and potential reward. Let's explore the most common ones. 1. Spatial arbitrage. Spatial arbitrage is the simplest and most widely used form of crypto arbitrage. It involves buying a cryptocurrency on one exchange where the price is lower and selling it on another exchange where the price is higher. For example, Bitcoin is priced at $30,000 on exchange A. Bitcoin is priced at $30,200 on exchange B. A trader buys Bitcoin on exchange A and sells it on exchange B, earning a $200 profit per Bitcoin. Advantages. Low risk due to simultaneous buying and selling. Easy to understand and execute. Works well with highly liquid cryptocurrencies like Bitcoin and Ethereum. Challenges. Requires accounts on multiple exchanges. Transaction fees and withdrawal limits can reduce profits. Opportunities may last only a few seconds. 2. Triangular arbitrage. Triangular arbitrage involves trading between three different cryptocurrencies on the same exchange. This strategy takes advantage of price discrepancies between the three assets. For example, a trader starts with Bitcoin, BTC,